Okay, welcome everyone. Thank you to the people who are joining me here today. And it is with great delight that I have decided to share some insights and some basic financial literacy, because I have been bombarded or baffled by the last couple of weeks with what's happened and how many people don't actually understand their financials. So I decided that's it. Yesterday afternoon, I finished work at 5 o'clock and sat here till 7 o'clock and quickly put together a presentation and thought, right, that's it. I need to put it out there. There's so many people that don't understand their financials. So my goal over the next hour is to share with you the basics, the basic fundamentals that you need to know as a business owner about the financials of your business. So I've got a lot to go through. I wouldn't normally really go through this in 1 hour, but I'm going to endeavour to go through the lot. Goal is by the end, you'll say, yep, actually, I do know a lot more than I thought I did. And I feel pretty good with it. And I know some of the areas I'm a bit blurry on, and maybe I need to do a bit more work on that. Or you're the other side where the whole thing is just, wow, I have no idea what she was talking about. It was another language. Well, then this hour will be a serious wake-up call for you to go and do some work on understanding what it means. And I'm happy to talk to people offline if it's all just a whole blur to them and they're like, and you're feeling, I don't understand it. So I'm going to go through step by step of what I feel are the basics that most business owners should know in relation to understanding their business financials. And we'll hopefully have time for questions at the end, but if we don't have time, because I've got a lot to go through, then you can email me afterwards, or I'm happy to have a phone call. So I'm going to share my screen and off we go. So hopefully everyone can hear me and we're ready to roll. So when we look at understanding financials, really, not only do we need to know about our historic numbers, but we also need to know what creates the future numbers of my business. So, and you'll hear me through this presentation talk about lag and lead measures. So the lag measures are the money in the bank, but the lead measures is what causes that money to be in the bank. And so often people are just worried about looking at, okay, money in the bank, but we need to know what causes that. So too many business owners, what we find is they have no accountability with making decisions because they don't understand their financials. So we need to find out, okay, if we want to manage something, we've got to start measuring it. So if we want something to increase, we need to start measuring it. So if you're wanting sales to increase or cash in the bank to increase or production to increase, we need to start working out what is that, what's that measure, that lead measure that we need to start measuring that causes the output to be a successful output, which is what we want, which might be greater production, it might be greater cash in the bank, it might be greater conversion rate, whatever that may be. So we want to look at historic numbers. We also want to look at the key performance indicators, indicators that create that cause that. So it's important as business owners for you to be informed about this. So we're looking at both lag measures and lead measures. So the lead measures is testing and measuring what happens, and the lag is the numbers, the results at the end. So what we're endeavoring to go through today is saying to us, okay, if we want to know about, having financial mastery, what do we need to know? Well, these are the main areas that I'm going to look at. So we're going to look at your profit and loss statement, what that actually means, so that you understand what it means and you start to look at it every single month. Also, how to work out your break even. If you don't know what your break even is of your business, that's that point where you start to make profit. You really need to work out how to work it out and what it is for your business. Break even per week, break even per month, per year. Also, what is the balance sheet and what does it mean? And how often are you looking at the balance sheet? And then also cash flow forecast. So how do we forecast now, especially at a time like this? We need to all have a really good cash flow forecast made between now and the end of the financial year. And with what you've predicted to come in, what the government help is going to give to us, how it impacts us, what the cash flow is looking like, what we have to put on hold, what we have to stop, if we have to, make some kind of adjustments. So we're going to look at the cash flow forecast as well. and look, do we have a cash gap? What is a cash gap? What does a cash gap mean? And is that applicable to your business as well? And also lastly, budgeting. Do you have a budget? So we're going to go through all of these, and hopefully you'll have a lot better understanding of what they all mean at the end. And they're just really looking at measuring how you're doing in different ways in your business. So the first one that we look at here is we look at the profit and loss. So what is a profit and loss? So a profit and loss basically is a statement that's from one period to another period in your business. So you might create a profit and loss for 1 week, you might create a profit and loss for a month, or you might create it for a quarter or for a year. Basically, it records all of your sales that you've invoiced. It also records all the cost of those sales. So that's the stock, or you might call it inventory, or you might call it contractors. So they're variable. And then that equals your gross profit. And then after you've made a gross profit, then there's fixed expenses, or some people call it operating expenses, that must be taken off after that. And at the bottom, at the end, you get your net profit. So that's how a profit and loss actually works. Now, you can generally get it easily from your going into your reports, saving it as a report. Great thing about most people is they have Xero, and you can easily get your bookkeeper to show you where that report is and start to produce it on a weekly basis and start to check in on it. So basically how it works is in very, very simple terms, we have the total sales less cost of the sales, or the stock, the variable, equals our gross profit. And then from the gross profit, we minus our fixed expenses. And from that, we get at the bottom our net profit. That's it. Nice and simple, really, really simple. So it's not something that's complicated. It's not something to be scared about. So starting to have the habit of looking at that on a regular basis is important, because then you know this is where we're at with our business. This is where we're at this week. This is where we're at this month. So remember, it's from one period of time to another period of time, and you choose that period of time. So let's have a look at an example of a profit and loss here. So we've got widgets here. So we're talking and saying, all right, well, let's look at what are our sales. So we've got sales here of various products. We've got sales here of different widgets, red, blue, green, yellow. That gives us our total sales. Now, after that, we take the cost of that sales away. Now, this is the interesting thing, which I know it sounds simple, but so many people don't do this. Let's look at separating the cost of the sales for those different product groups, because then we can see which product groups are more profitable than the other product groups. So then at the bottom of that, then we've got our gross profit at the bottom. So after that, after our gross profit, then we've got all our fixed expenses or our operating expenses. So fixed or operating expenses, they're all the things that we have to pay regardless of whether we make a sale or not. They're all the things that happen every single month regardless. And at the bottom, we've got our net profit. So when people talk about gross profit is what we want to increase at the bottom. That's what is important to keep business profitable, is having net profit. So that's nice and simple. Now, a few questions some people have asked before. So some of the questions that people ask is, what is the difference between, you'll see in some profit and losses, or some people talk about cost of sale or cost of goods. That's what some people, often will talk about. Or some people call them variable. These are basically, they're expenses that are only incurred if there is a sale. If there's no sale, these expenses are not incurred. So it's if the sale was not there, this cost would not be there. So it doesn't matter if they're called cost of sale, variable cost of sale, or cost of goods, they all mean the same thing. So nice and simple and easy to remember. So another common question is, when I buy stock, is it considered to be an asset, or is it considered to be an expense? So answer that question is, when you buy stock, it's actually considered an asset, but then when you sell it, when it gets invoiced and sold, it's actually called a cost of sale, because that sale that you've done has a cost against it, and that cost is for that stock. So what happens is, this way it makes it so much easier, because if you buy a whole lot of stock, and imagine if that cost of sale went through on the month that you bought it, then it would be out of balance. So what happens is, the stock, when you've bought it in, it stays as stock, as an asset, and then it's not actually on your balance sheet, but I'm going to explain balance sheet in a minute. So it stays there on your balance sheet, and then as you sell the goods, then the cost of sale gets allocated and goes into the profit and loss as a cost of sale. So just a question that often people say when I buy stock, is it an expense or is it an asset? And that's just a simple one. Also, other common questions that people ask me, cash or accrual counting, what's the difference between cash or accrual? No, it's a simple question, but so many people ask me this question, and sometimes people are a bit afraid to ask the really simple questions. So cash is when our accounting system, we've ticked the cash button and we're generally turning over, not a high turnover in our business, but cash means that the business, the profit and loss is based on money going in the bank and money going out of the bank. If it's an accrual system, so you're doing a profit and loss on an accrual system, or you're accounting on an accrual system, it's based on invoices that you've actually invoiced. So you might not have received the money for that sale yet, or you might not have paid the money for that invoice that you've purchased something, but the actual profit and loss is all based on everything you've invoiced in and everything you've invoiced out, and that's called an accrual system. And generally when businesses turn over a lot more, they're forced to go on an accrual system. So again, a question that I often get asked that I just wanted to demystify and make it nice and simple. Most small new startup businesses are cash, and as they get bigger, they turn to an accrual system, which is just based on the invoices. So another question, discounting versus increasing prices. Now this one is quite an interesting one, because we look here and see we've got a product here that we've sold, and it looks like we've got a 60%, we've got 60% cost of sale in it. Now, if we look at discounting this by just 10%, what happens? We discount it by 10%. What we've done is we've just eroded our margin by a huge amount. We had a 40% gross profit margin. Just by discounting 10%, we've taken 25% of the profit off. So as we can see, when we're looking at discounting, it's a very, very powerful way when we look at it like this to see how greatly it can affect your business. So we're saying 10% discount, if you've got a gross profit of if you've got a cost of sale of 60%, you're actually giving away 25% of your profit. So it's not really a 10% discount. The 10% is on the whole amount. So you're actually giving away a huge portion of your margin. So I would err away from discounting if possible. The other one to look at is increasing prices. So if we look at increasing prices, when we say the same thing, if we've got a 60% direct cost or cost of sale, and we look at just increasing the prices by 10%, what's happened to the profit there in this chart? We've actually increased our profit margin by 50%. Dramatic, absolutely massive. So really powerful little charts to just look at to make us aware the impact of discounting and the impact of increasing prices just a small bit, because people think of it as the wholesale price. They don't think of it as how much it impacts the actual gross profit margin. So interesting one to look at. Now, let's look at some numbers. I've had lots of people ask me about how do we work out our gross profit percentage. So this is what we do. So we look at saying our total sales figure minus our cost of sale figure equals our gross profit. Then we say, all right, we divide that by our total sales figure and times that by 100 to get a percentage, and that gives us our gross profit percentage. So with some numbers here, we've got sales of 122,000, and we take away the cost of the sale or the stock or the cost of goods, we take that away, and that then gives us a gross profit of 59,000. So I hope everyone's with me. This is really, really simple. So this can be done on a whole period of time, or it can be done on one product. Really powerful to do it on one product, because then we can see which products we've got more margin in than others. So we've got our gross profit figure. We divide that back by that total sale figure of 122,000, times it by 100, and that gives us our gross profit margin percentage. So what that means is that if our gross profit margin percentage is 48.3%, every $100 that we sell of goods, or every $100 that we invoice, $48.30, we actually get to keep for gross profit margin to pay for our expenses. So in effect, the higher we get this gross profit margin percentage, then what's going to happen is the more money we've got to pay for our fixed expenses, to pay for our operating expenses, if that makes sense. So if we're looking here at saying, how do we increase this number? Because it's powerful if we increase it, because by every percentage we go up, it's increasing money to pay for wages, to pay for other expenses. Things that we can do, we can sell goods on higher margin. So imagine if red widgets, blue widgets, and yellow widgets, whatever they are for you, have a different profit margin, one of 20%, one of 40, and one of 55. Well, if we focus on the ones that have 55 cents in every dollar that we get to keep, we're going to be a lot more profitable. And when I do my business planning workshops, I had a manufacturing firm that I asked as part of our homework to go and look at all your main products and have a look and say, what's the margin? What's your buy price and sell price in all of the products? And he came back the next day and said to me, that was an amazing exercise. And I said, what was so amazing? And he goes, do you know some products have a lot higher margin in than others? And what would happen if we just focused on products with a higher margin? And I was like, wow, amazing. That's what I wanted to hear, music to my ears. So if you don't know which products have the higher margin, it's really hard to get your team or for yourself to focus on selling them if you don't know. But the more we focus on products with higher margin, the more gross profit you're going to have in your business. So 3 strategies to increase your gross profit: sell products with higher margin or services, renegotiate with your suppliers or contractors, see if you can get better buy prices, or increase your prices by 2, 3, 4, 5%, only a small percentage. Other things, if you're wanting to increase your net profit, we've got to look at obviously increasing sales, increase the gross profit, which we've just talked about, or reducing expenses. Very simple, very basic. So if you're looking at saying, yes, I'd like to increase my net profit, okay, what strategies? So what are the lead measures? What strategies are you doing to increase these areas? There needs to be some action. There needs to be some strategy in there if you want to increase them. So I hope that makes sense. And again, ask me any questions after, or email me, or I'm happy to talk to you on the phone if this is gobbledygook. Another question I get a lot: markup. What's the difference between markup and margin? I had one very sad supermarket owner that had it totally wrong, and it was causing his business to go backwards quickly, and he came to me and he didn't understand the difference between markup and margin. So mark up, we're marking up from the buy price. So in this example here, we buy something for $100, we mark it up 50%, so it means we sell it for $150. So we've got $50 profit. So that's markup. Generally, when you're talking in retail, they often talk about markup. But in some businesses, often business to business, we talk about margin. Margin is going down from the sell price. So if we're looking at margin, we buy something for $100 and there's a margin of 50% in it, it means we're selling it for $200. So the profit is $100. So the difference between markup and margin is markup is marking up from the buy price, and margin is the margin from the sale price down. So I hope that demystifies that one. Another question comes to me all the time is, how do we work out break even? Now, break even is the point where you start to make money or make profit, but I prefer to say break even plus profit, or break even including profit, because if you're wanting to go forward in your business you're wanting to invest money in it, you need to be making net profit regularly. If people want new computers, if people want pay rises, if you want to, give people bonuses or get some, assets for the business, you need to be making consistent net profit. So really break even needs to be break even plus profit or break even profit. So as we see here in this example, what we've got is a very simple example here that says our fixed expenses are the red line. They're our fixed expenses. They're a given. We have to have them every single month. They're our fixed cost. Then the next line above that, we've got our revenue. So our revenue is our blue line. That's our sales. So as our sales go up, we can see there's another line parallel to that, or perpendicular, sort of going up at the same angle, which is our variable costs. So as those sales go up, we have our variable sales go up. So then we also have our total expenses. So that's the total of everything. But you can see here, there's a point where the arrow is, where it's the break even. And then there's the point above that where it's profit. So we want to be very clear of what is that figure in your business of that break even point to see. And there is actually a calculation. There's a formula here. It's a break even formula. So it's looking at saying, what is break even plus profit? So we've got fixed expenses plus the profit divided by our gross profit. That will give us our break even. So to calculate it, we need to work out what our gross profit is, which we just did a minute ago with that formula. So that's the percentage that we keep in every sale after we've paid for our stock or for our supplies. And then we divide that by the revenue. So then that way we can get our break even. And I would always recommend to add profit. And as I said, if this is confusing, happy to help with sharing any of these slides or happy to help with speaking to someone on the phone. So that is really, that's the end of the first main document that really we all need to be very familiar with, which is the profit and loss. And I would recommend for people to look at it at least minimum every month. So that's from one date to another date, all the sales invoiced, all the expenses and the net profit at the bottom. That to me is really just a mandatory every single month. Now, the other document that a lot of people never look at is the balance sheet. So the balance sheet is different from the profit and loss. This is a snapshot of one date. And this is a carrying on record. So it's not from one date to one date. It's a point in time and the numbers are following on. They're compounding. So what it does, it records all of our assets in our business. It records all of our liabilities in our business. And it gives us the health of our business and the equity. And it gives us an understanding of the value of our actual business. And this balance sheet, it's carried on from the date that the business actually started, from the inception of the business. So this tells us how healthy our business actually is. So if we're looking at, well, okay, what are assets and liabilities? Well, assets are things that we own and liabilities are things that we owe. So it's pretty simple. It's not as complicated as you think it is. And equity, well, that's the outcome. That's pretty much it. That's what a balance sheet is. Balance sheet 101. It's not very complicated. So if we want to break it down a little bit further, we've got assets of things that we own. That's things that we own in our business. And then there is two types of assets. We have got current assets, which is things that can actually be converted to cash very quickly. So these are things like things that can be converted to cash quickly, cash in the bank. This is invoices. This is maybe it might be some stock, things that are very current assets that can be turned into cash in this current period. We've also got fixed assets, or sometimes people call them long-term assets. These are things that have a long term. They might be machinery. They might be buildings, vehicles, that sort of thing. So these are all the things that we own in the business. Another thing that sits here in the assets is money you've collected for the taxman. If you've collected your people's tax, your PAYG tax for the taxman, that sits here. That doesn't go in the profit and loss. GST is sitting here that you're collecting for the taxman. So when we talk about the profit and loss that I've just finished talking about, that doesn't have GST on it. So This is where all the assets sit. If you are a kind of business that might take deposits, the deposits will sit here. They're an asset. So after the assets, we look then at saying, okay, well, what are the liabilities? So the liabilities here, they are debts that the business has. These are suppliers that you might owe, invoices. There might be loans, or maybe credit card loans. There might be debts, something like that. We've got two types. We've got current and we've also got long-term. So long-term might be a mortgage to the bank. It might be a long-term loan. Director's drawings, you might have lent the business money when it first started. So any big long-term loans, that's pretty much the liability side of things. So just remember the balance sheet, it's balancing up the success of your business, the health of your business from the start, from the first day, everything you owe and everything you own. Simple as that. And the health is the difference. The goal is we're wanting to go forward. So equity, that's the difference. So difference is assets minus liabilities equals equity. Now, I know this is really simple, but sometimes no one's ever explained this to people. So that's what I really wanted to do, is explain it to people so that it's just nice and simple for them to understand. So the balance sheet shows the value, and as your business increases, the value of this on the balance sheet should be increasing. That's what we're wanting to look. And this balance sheet actually shows the health of your business. So 2 documents, love you to look at them every month: the profit and loss and the balance sheet. So these 2 documents need to be looked at in sync with each other, because sometimes people will say, I've had a really good month, but I can't see lots of money in the bank. Well, maybe there's lots of people that owe you money. Maybe you've got lots of debtors out there. Maybe you've got lots of invoices out there that people owe you. Or maybe you have it, you think you've got lots of money in the bank, but on the balance sheet, the creditors, you owe lots of money out. So that's why we really can't tell how healthy a business is just by looking at the profit and loss. We need to look at the balance sheet as well as the profit and loss. What happens if you've got lots of money in the bank and actually really that's the bank's money? I would always urge have a separate account, not the bank's money, the taxman's money. I mean, I would always urge have a separate account that you put your GST in, your PAYG, your super, all the money that's not yours, put it away in a separate account every week, so that you don't have the illusion of thinking I've got lots of money in the bank and it's actually not your money. It's actually sitting on the balance sheet waiting to be paid out as super, waiting to be paid out as GST, waiting to be paid out as PAYG. So I would always urge you to have a separate bank account for that, so you're not fooled by that. So we're talking about cash now. So I hope that demystifies balance sheet. It's not complicated. So then we look at the cash flow. So basically profit is a theory because we're talking about, how that works, but cash in the bank, that's fact. We can see there's cash in the bank. So what we're wanting to look at when we look at cash, now really the cash flow, as far as I'm concerned, it's the combination of the balance sheet and the profit and loss. So we need to always be looking at our cash flow as well. So this is the 3rd document that I really want people to understand needs to be looked at on a monthly basis. And this is cash flow forecast and cash flow, what's happened in the past, where's the cash gone. So sources of cash, we've got cash generated from sales in the business. These are the main sources of cash. We've got also cash generated from borrowing money from the bank. And at the moment, some people are taking advantage of, cheap mortgage rates or cheap loans and borrowing money from the bank, or selling an asset, or someone giving an injection of cash. So they're the 4 main areas that you can actually source cash. Then main uses that we have for cash are general expenses, all those general expenses that we said, those fixed expenses, purchasing of assets, of fixed assets. At the moment, we've got some good tax incentives to buy assets so that we can write them off. Also purchase of stock, so that you've got stock to actually sell, or also loan repayments, paying off your loans. So these are the main sources of cash and the main uses of cash. Owner's drawings are another one. they're one that often people don't take wages, they take owner's drawings instead. So having a cash flow forecast is key to understanding where you're going with the business and ensuring that you're understanding that there's no surprises. So the cash flow forecast, it's a bit of a tongue twister, is where we record our spending habits in the business. Because remember, we've talked about the profit and loss in the balance sheet, and money comes in and out of both of them. So it's really hard to make sense of them. And that's why I urge this third document to be the, I suppose, the conduit between the two, that we need to always be looking at on a monthly basis, because cash flow happens out of both the profit and loss and the balance sheet. So it records our spending habits, it records our cash at bank, also our loan repayments, and also any incoming cash as well, and outgoing cash. So the whole aim of this is to have positive cash flow. That's the aim. We're wanting to have positive cash flow in our business. You know, and if you're doing a cash flow projection and you're doing a cash flow forecast and you're tracking it on a daily or a weekly or a monthly basis, we really always need to be looking at and saying, how can we get positive cash flow? How can we get positive cash flow? Because the longer we continue to have positive cash flow, the healthier a business that we're going to actually be in the long run. So when we look at a cash flow forecast, what do we need to do? Now, we need to enter the first date, the date that we're actually doing the cash flow forecast from. We start it with the opening bank balance. And if there's any credit limit, it's good to include that so we know when we're going over that. We also record all the cash in, all the sources of cash coming in, and all the sources of cash going out. So see how we're joining the profit and loss in the balance sheet here, because this is the cash. So enter everything. So if you're paying off your credit card, or if you're paying tax, or if you're paying super, or if you're paying GST, whatever it is you're paying, all the sources of cash go in and out in the cash flow forecast, so that we can see that we are going to be going forward and positive. So some of the things to consider is, there may have to be some rough guesses about cash coming in, because sometimes people say, well, how do I know what's going to come in? How do I know? How can I predict my sales? Well, looking at predicting what are the minimum or the normal sales for this period of time in your business. And then looking at, we know generally what we've got to actually pay out, because we know what our wages are, we know what our rent is, and that will give us an estimated amount that we can actually be, pretty positive, or pretty sure that it's going to actually happen. And then as we get closer to that time, we can adjust it. As we receive payments, as money gets adjusted, we can move it around and adjust it accordingly. I would recommend, especially in these times, be looking at it at least once a week. Daily would be good, but once a week at least. We would want to be tracking, making sure that it's balanced with the bank statement each week or each month, depending on how closely you want to track it. So it just, I had a client once, and when I went through this with them, because they found it really confusing knowing how much money was going to be in the bank, and making allowances for tax and GST and credit card statements due and paying suppliers, and they just found it really confusing. When we went through this, they called it their pot of gold, because they called it a pot of gold because they said once they got to know how to do this, it gave them choices. It gave them choices of what they wanted to include in this going forward, and how much they had to invoice, and what the expenses had to be to include whatever it was that they wanted to actually spend money on in their business. So as you can see here, I've included a very basic cash flow projection, nice and easy. We've got opening bank balance, we've got our projected sales coming in, and all of our materials that we've got to pay for, our accounting for the month, whatever our expenses are for that week, our projected total out, and our cash flow and our closing bank balance. Really simple, just a simple Excel spreadsheet is all you need. Yes, there's a lot of fancy programs that are out there that you could use. We just use a simple Excel spreadsheet, nice and simple. But it's just a way of you knowing for sure what you can control, so there's no surprises. So you can look at that cash flow flow projection and say, oh gosh, it's going in the red here. We'll have to hold that payment, stop that payment, halve that payment, or come on guys, let's get greater sales in that have higher GP and have higher gross profit. So we need to get some more money coming in here. So you're really well informed about what the potential is for your business as far as cash flow for the coming, 3, 6, 7 weeks coming. And it should always be that rolling, updating all the time. And at the moment, it's crucial that we need to be looking at what do we do to go out, what can we store, what can we hold, what can we change, what can we increase, what industries need us more now, what products have got higher GP in that we can focus on, so that you really have, you feel empowered to actually change the cash flow to make it positive if you can do that. So happy to share our spreadsheet with you or our template if anybody would like to share it. Still on cash flow, often people talk to me about the cash gap, and it's one of those business terms that I've seen people glaze over and go, well, what's the cash gap? I don't know what the cash gap is. So the cash gap, it is the difference between the amount of money you have coming in to the amount of money going out. So goal is we want to have positive cash flow. So it's about money getting in, money getting out, and stock. And generally when we talk about cash gap, it's related to stock. So I've got a little picture here that will explain it. The picture says 1,000 words. So we see here that we buy the stock. The stock arrives. That's the inventory. That's a big green line here. That's the inventory comes in and we get an invoice. So that's the blue line where it says payable. So then we're due to pay that. So when our money goes out when that invoice is 30 days old. So then as you can see, there's the red line there that goes all the way along. And this cash gap could be the same actually if you're paying for tradies, if you're paying for staff or contractors especially. So then what happens is we ship the goods or we do the service, whatever it may be. And then we've now got to wait that whole yellow line for receivables. So that whole red period of time from the minute we've paid that invoice is the cash gap. So our goal is to look at saying, has my business got a cash gap? Is that affecting my cash flow? And can I reduce the cash gap? Is there any way I can reduce it? So if we are going to look at reducing it, there's a few things that we can do. We can increase our payable periods so that we're actually, taking a bit longer to pay. We can also get our collections period, make our people pay us a little bit quicker. Or also increase our turnover period of time. These are just some ways that people can look at actually decreasing that cash gap. So if you have got a cash gap, talk to your team about how you can reduce it, because that's going to help you with cash flow in a big way. The thing is, tradition and the nature of business, often, there's often different idiosyncrasies with different industries. Some have a higher cash gap than others. So look at yours, and if you do have one or you don't have one. So that's cash. Now, what we also want to look at is, what are the key performance indicators in your business? Or some people call them the key success factors. Now, these are like the veins or the heartbeats of your business. So when we look at financial ones, so the ones that we've just been through, so your profit and loss and your balance sheet, sales, revenue, things like this, these are lag measures. So these are after the effect. These are after it's all happened. So these are the things that we measure to see how we're actually going. But what we want to know is, what are our actual KPIs, some people call them, or lead measures, some people call them, or critical success factors, some people call them. What are the key activities that drive those numbers? Conversion rate's a big one. Start measuring your conversion rate if you don't know what it is. Gross profit margin in different products, that's a huge one. So you may have a critical success factor that may be, we need to sell, all our products need to have a minimum of 50% gross profit margin in to cover all of our fixed expenses. Or we need to, another critical success factor might be that we need to have, one of our KPIs is we need to have a minimum sales of 50K a month to cover all of our fixed expenses because our margins are X and our fixed expenses are 20K a month. So that's a critical success factor in our business, or some people might call it a KPI or a lead measure. So we need to know, what are the lead measures in your business that cause success in your profit and loss, in revenue, in gross profit, in getting you to go cash flow positive. So some people have that as production. Some people have, you know, looking at saying, okay, if I'm hiring people to do a job, we need to make sure that their production is minimum of 80% billable hours. They might be, you know, technicians, or they might be tradies or something like that. And they must make sure that they're invoicing out 80% of their time to be productive, because you pay them wages, you pay them holiday pay, you pay them sick pay. They need to be productive. So if you don't know what your key performance indicators or your key lead measures or your critical success factors, everyone has different names for them, you know, find out what they are. What's that point that in your month where you know it's that point from success and failure, that point where, yes, it's going to be a good month. What are the things that happen when it's a good month, opposed to what happens when it's not a good month? We need to know what they are and what are the actions that actually cause that. And they need to be clear. And if you need help, I'm here to have a chat. So the last document that I want to go through with you is look at saying, are we budgeting for profit? So people often get budget and cash flow projection or budget projection mixed up. Now, a budget, basically a budget is essentially a target or a goal for the business. And it's usually a turnover figure or a gross profit margin figure that you'll actually look at targeting. So it's often based on the profit and loss, but it's generally done on a month-by-month basis, and it's often based on coming out of your business plan. So with my, you know, a lot of people that I work with most of them, they have a current business plan. It's a 5-year business plan. Year 1 of that business plan, we pull it out to a budget, so we know what is the target invoice figure for every month, what's the target gross profit figure, what's the target figure for our fixed expenses. So they're goals. So they're the year broken down into months, and then that's the budget for the team. So it's the budget for the sales team. It's the budget for the admin team to keep the fixed expenses down. It's the budget for the general manager or the owner to keep the gross profit at this figure. And it's different from the cash flow because, as I said, the cash flow, we're taking into account everything. We're taking into account all the cash that comes in and out. And a lot of that is not yours. A lot of that is the taxman's or people's tax. So we want to look at saying, what are we doing to have a budget or a goal for our business every month that we share with the team, so they know, hey guys, our goal turnover this month is this, and you know, we're looking at targeting our margin on this. So if we're looking at putting together a budget, I've seen some budgets put together terribly. They just, you know, add a certain percentage. Well, don't. You know, be realistic with your estimation. Start from zero, and start from scratch, saying, okay, well, you know, where do I want to go with this business? What's my goal for the business this year? And then work that way. And if it moves or changes, make sure you budget for it. Because often I'll do business plans with people and they'll say, okay, we're going to have a new person coming on here. Well, we need to have that budgeted for. Or we're going to bring a new product in here. That needs to be in the budget. Or we're going to move office here. Well, have we got that in here? Or we're going to get a new car here. Well, is that in the budget? We need to make sure that we're very clear, what is our budget for success? What does success look like? And then we can go and do it. So when we look at a profit and loss, mostly Xero and MYOB have a budget facility. So you can type all your goal numbers in, and then every month you can get a report of the profit and loss that says budget to actual. What was your target turnover? What was your target gross profit? What was your target fixed expenses? What was your target rent? Oh, why was that different? What was the target for insurance? Ah, yes, that got paid twice. Okay, we need to adjust that. So that every month you review that profit and loss. When you review it, you review budget, actual, budget, actual, budget, actual. So that you've always got a goal to how you're tracking to achieve your end of year target. That's year one of your business plan. So you've got a seamless path from where you are now to where you want to go in your business long term, whether it's to create more value in your business to sell it, or whether it's to put a manager in and step back, or whether it's to grow it, it doesn't matter. The key is to be reviewing often, and also have someone accountable. Have someone accountable to actually every month going through it and attending to everything that needs to be attended to. I don't think I've ever gone through a profit and loss to budget and an actual to budget where there's not been actions coming out of it, that something's not being quite right or something needs to be adjusted. It's crucial. And funny thing is, I was having a meeting with a client a little while ago, and I said, is your budget up to date? And he was like, oh, I haven't looked at it for ages. And I said, well, let's hop in and have a look at your budget to actuals in Xero. And it was really funny because he hadn't played with it for a long time. He hadn't updated it, but funnily enough, the profit figure that was in there was down to $1 of what his profit figure was. And so I'm like, be careful what you wish for. You've taken your eye off the ball and not updated your budget, and look what's happened. You've just ended up where you've ended up. So it's about being clear. I want success to happen in my business. Let's get a really great picture of what that success looks like in a clear profit and loss budget. And then we can go around and be very clear with all the people who are accountable for each part of it: the marketing, the sales, the operations, the admin, the HR, all the people that are accountable for each of those sections. And that's their target. And they're very clear on what their target is and what they want to achieve. So it means when we get to the end of the month or the end of the week, everyone's accountable for what part they play in that successful failure. And if you haven't met the target, well, let's review it in those particular areas. What do we have to change? What are the activities? What are those lead activities that will attribute to changing that next month? So it's just such a simple thing to say, if you don't know what success looks like at the end of this month, it's going to be really hard to actually get there. It's like hopping into an Uber driver and saying, I want to go here, but I'm not sure where here is, or what it looks like, or what time it is, or where it is. It's about saying, I need to be here by then, and this is what I have to do to get there. And it's no different with a budget. So here's a little example of a very simple budget. It's just the same as a profit and loss, but we're actually budgeting for the business and looking at, okay, what do we want to happen in the future? Couple of things to also mention is if you're wanting to have a budget for profit, there is, I suppose, a good argument for including some of your cash items in your budget as well, so you're not fooled, because I have seen people say, hey, my profit and loss is looking great, but I never have any money in the bank. And that's because they've only based it on the profit and loss. So sometimes what I'll do is at the end of the profit and loss, I'll put, remembering to add items that are on the balance sheet. So you might be wanting to purchase an asset, or you might be wanting to, look at, say, reducing a liability or things like this, changing debtors, creditors. Directors' drawings is a big one. That's a really big one, because people will say, oh, we've got profit, but then there's never any money. Well, that's because you've taken your director's drawings after the profit. That's not included in the profit and loss. Director's drawings, they're on the balance sheet. So to sum up, I've said a lot, and I'm sorry. I knew it was going to be a lot to get through, but my goal was to get through the basics. So now you know what you don't know. And now you know the areas that you really need to work on. Now, if I've gone through this and it made sense, well done to you. And hopefully you've picked up 2 or 3 points. I could do that a little bit better. I could do that a little bit better. So the big picture is there is a profit and loss, all your invoices and expenses. There is a balance sheet, all your assets and liabilities. This one here is from one period of time to another period of time. For the week, one date to another date, the month, one date to another date, the year, the quarter, whatever. Balance sheet, it's compounding. It's the assets and liability at one point in one time from the start of your business. So that numbers, they're carrying on all the time. So there's assets and liabilities, there is invoices and expenses. And operating expenses of the business. What lies in the middle is the cash flow. The cash flow is the joining of the both. I would recommend always print and review your profit and loss every month. Always look at your balance sheet every month, and then look at your cash flow projection. That is the joining of the two, because that's all the cash going in and out of your business. The budget is looking at saying, what was your goal in your profit and loss, and how did we do to actual? So the budget is the actual goal. So I hope that is summing up in a simple, nice, clear to explain manner. Some home fun. Make sure all your financials are entered and reconciled at least once a month, because how are you going to know where you are if you're not reconciling them, and if they're not up to date at least every month? Review your profit and loss, your balance sheet and your budget every single month, at least every single month. And make sure you act on anything that looks wrong, or that's any anomalies, anything that looks a bit odd. Work out what is your gross profit margin of your business, of your main products, and make sure you know what the margin is. And I urge you to have strategies to increase that margin. Please know the products that have the highest margin and the lowest margin, so you and all your team can focus on that. It's important. I've worked with companies where we've started off with the average gross profit margin at a very low percent, and then over 12 months we've focused on educating them on which products have a higher margin, and the gross profit margin has gone up dramatically. Work out your break-even point so that you can get to the point in the month or the point in the week and go, yay, it's profit from now on. We've got past our break-even point. But make sure you include the profit, break-even plus profit. There's no point in being business to make zero money. There's no point in that. Please have a cash flow forecast. Now more than ever, we need to know what our cash flow forecast is coming up from now to the next, really the end of the financial year. It's really important. Have a budget as well. I always prefer to have a 12-month budget, but at least 90-day budget, so you know what your targets are, and you can share the targets with your team. Our target is this of sales this week, this day, this month. Our target is this gross profit. Lastly, decide on what are your key performance indicators, or your key lead measures, or your measures that are going to contribute to your success. So know what they are, decide what they are. And then that way you can focus on strategies that are going to help you achieve the outcomes that you're actually wanting to achieve. So that's it from me. I know that was a lot. I have hardly taken a breath, and I hope it wasn't too complicated for you. I've got about, a few minutes. If there is any questions, that are very quick, easy questions, you can put them in the chat box. Or if not, I'm more than happy for you to email them to me, or text me, or ring. If you've also got any questions about the government incentives at the moment, I've got an amazing accountant and bookkeeper on hand. If you're interested in learning more about the asset write-offs or refinancing, I've got an amazing guy who specialises, who's also an accountant, who specialises in asset finance. He can look at refinancing for you. And please talk to your banks, and please talk to your team, that we're all in this together, and we're all going to support each other together. So I'm happy to share my trusted allies with me if you have any questions that needs a specialist. So I hope that helps. I hope that demystifies everything, and happy to help you if I can help you. Thank you very much.